Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
This episode is brought to you by Latin Excellence. Visit latinexcellence.com. That's Latinx, CELLENCE.com or latinxmovement.com to learn more and shop our merchandise. You are excellence. Hello and welcome to another episode of On My Way to Wealth. My name is Luis and I'm your host. Thank you all for tuning in. Today, I want to talk about the stock market. I'm sure that it's on your mind one way or the other. You can't escape it from your phones to the news, right? Everybody's talking about the stock market being down. So I wanted to talk about it because combined with other things that are going on in the world, like high inflation, the war with Russia and Ukraine, and other things that are going on in general, I think a lot of people are very nervous, and rightfully so. And what I wanted to talk about today are some of the do's and don'ts of when the market is down, because a lot of people that are nervous sometimes, unfortunately, make some decisions that are fear-based, and it's not necessarily in their best interest long-term. So let's get a couple of things out of the way. One of them is very important, is if you have money invested, it should not be money that you plan on having access to in the short term. So in other words, I always preach about having your savings, like emergency savings in a savings account that you can easily access so that it's very liquid, accessible, and safe, right? Even if it's not returning a great rate of return, because the main purpose of that money is to have it accessible. Number two, if you have any money outside of that you have for a goal, say, for example, you're planning on buying a house in 1 year, for example, year and a half, even maybe two, I usually don't recommend that money gets invested, because you can be out a significant amount on that money by the time that you actually need it. You know, if you were saving for a house and you had your down payment and closing costs back in, say, December 2019, and you decided to invest that in the market, well, just a few short months later, the market dipped significantly over 30% when the pandemic started, right? And you would have been out a significant amount of money, which is one of the reasons why I always tell my clients, any money that you feel like you might need in the short term is not the type of money that should be invested in the stock market, right? So the stock market is for people that have a long-term approach, that are in it for the long haul, and are willing to take a certain amount of risk. You know, and this is one of the things I want to talk to you about. You know, before you even start investing, you want to determine how long do I need access for this money? What type of risk tolerance do I have? And also, what am I going to invest in, right? One of the things that I have seen, unfortunately, is people that have never invested before and then go immediately into investing into high-risk assets and putting all of their eggs in that one basket, right? So I've seen people invest, whether it's individual company stocks, like the so-called meme stocks, or cryptocurrencies, right? And all those can serve a purpose and have a place in your portfolio. But unfortunately, a lot of people have gone from like 0 to 100, right? From never investing before to automatically just jumping 100% into something that is very high risk that they perhaps don't even understand, right? And now they're really feeling the pain, because most of the asset classes, as you've seen, are down, including cryptocurrencies and stocks, and the stock market in general, right? So some of the basics is think long-term, right? When the market is down, the one thing that you do not want to do is panic. And I'm going to give you some data that's happened historically, just so that you get some context as to why I say that, right? So do not panic when the stock market is down if your investment approach is a long-term one, which it should be if you are investing in the stock market. Second thing is, you want to make sure that your funds are diversified so that you don't have all your eggs in one basket. You know, like the example before, you don't want to have all your money in crypto. You don't want to have all your money in individual company stocks. You do not want to have all your money in gold or silver, et cetera. You never want to have all of your money in just that one thing. You always hear about financial planners talk about how you want to have a diversified portfolio. And what that means is that you have your money in different sectors of the economy. And more importantly, you have your investments in things that do not necessarily correlate to the stock market. For example, real estate could be one of those that doesn't necessarily go hand in hand, because you don't want all of your assets to go up at the same time or go down at the same time. If they are, then it's probably a very good sign that you're not well diversified. Now, when you're diversified, you give up some of the returns as a result because you're helping reduce that risk. And that's one of the benefits of working with a financial planner, is to help you determine what is your risk tolerance, what is the best way for me to diversify my portfolio based on several factors, including your age, what you need the money for, when you need the money, and so on. Now, another thing is, when you're talking about not panicking, let me give you some stats as to why I say that you shouldn't panic. So a lot of people are talking now that there's a possibility of a recession happening in the United States. Now, let me tell you what a recession is by definition. The National Bureau of Economic Research used to define a recession by 2 consecutive quarters of negative gross domestic product. So basically 2 consecutive quarters of the economy going down. They have since revised that definition. And the new definition is a significant decline in economic activity spread across the economy, normally visible in production, employment, and other indicators. A recession begins when the economy reaches a peak of economic activity and then ends when the economy reaches the bottom part of that. So you don't know that you are in a recession while you are in the recession. You actually find out after the fact, when economists look back and see the economic activity during that certain period. Now, a lot of people are thinking, well, we may be going into a recession. Should I pull my money out of the stock market? Let me give you some context. I want to show you some of the greatest stock market crashes that we've had in history. And I also want to show you some of the recessions that we've had in the past as well, and how long they lasted. So let me give you the real big one, right? The Great Depression. This was the late 20s, early 1930s. It started August 1929 and ended March 1933. That lasted for 3 years and 7 months. It was a very long one, right? And everybody has heard about the Great Depression, even if we weren't born in it, because it was that big. All right. Now, there's 2 things at play here. One is the stock market, one is the economy. They're not one and the same, right? So we had 3 years, 7 months for the economy to recover. Now, the market actually bottomed out in 1932 at more than 80% below the peak prices and took over 10 years to recover. Over 2 decades to recover. So 2 periods of 10 years almost to recover from the huge market drop. Now, we haven't had a drop that big since. So I'm going to give you some other examples. Another one that lasted a long time was the Great Recession of 2008. A lot of you remember that one. It started around December 2007, ended June 2009. It took 1 year and 6 months in comparison to come out of that one, which isn't that terrible when you look at it from a historical standpoint. The S&P 500 lost nearly half its value, and it took 2 years to recover during that time frame, right? So I wanted to give you that context, because what I noticed that happens is that the events change, but for the most part, the overall general concept is the same, where we have a period where we have low economic activity. You might have some unemployment. You may have high inflation. You may have the stock market going down. But what I've seen is over the years, these recessions are actually tending to get they become a lot quicker for the recovery period. To give you one example, look at the most recent one that we have in history, the recession of 2020. It happened February 2020, and it took 3 months by May 2020 to recover from it. COVID-19 spread globally, February 2020, the market fell over 30% in just under a month, which is a huge drop. But by August of 2020, the market had already rebounded and only took 6 months to recover. So this is a major thing I wanted to point out, because the one thing that you do not want to do when the market is down, if you have a long-term approach, is to panic and then sell out of fear. A lot of people think, well, when the market is down, maybe I can sell so that I don't lose any more, and then wait until the market rebounds. And then when the market rebounds, I'm going to jump back in and then ride the wave up, right? But here's what happens. When you do that, you're actually generating a real loss, right? Because you still own the same amount of shares. The value of those shares just happens to have gone down. But if you say, you know what, let me sell these and go to cash, well, now you've made that loss real, right? You realize that loss, you're sitting on cash and you're waiting for the market to rebound to then jump back in. Now, one of the worst things that you can do is time the market. You hear from all these legendary investors like Warren Buffett, nobody has the crystal ball. Nobody has the ability to know when the market is going to go back up. So the worst thing you can do is panic sell and then try to time the market and see when it's going to rebound. So I have some data that I wanted to share with you as well that I think is going to be helpful in determining in terms of what the outcome can be if you miss some of the best days in the market. So JP Morgan Chase has a retirement guide, which I'll put a link to in the show notes. And it was pretty cool to see. They basically did this research and they studied the S&P 500 and they used a hypothetical amount of $10,000 invested between January 1st, 2002 to December 31st, 2021. Right. And what they show is in this graph, which, you'll be able to see when you click on the link, you get to see the return that $10,000 would have had in the S&P 500, depending on how many days you kept that money in there, right? So obviously it doesn't go up in a straight line. It's usually a roller coaster a lot of the times. But historically, over time, the S&P 500 has actually returned just slightly over 10%, right, on average. So here's what happens. They show these $10,000 invested at January 1st, 2002, all the way through December 31st, 2021. If that $10,000 had remained fully invested and you never took it out through the ups and downs, it would have returned 9.52%. And the total of that $10,000 would have gone up to $61,685. Now, here's what happens. If you miss just the 10 best days of the market, you would have gotten a return of 5.33% and have $28,260 instead, just missing the best 10 days of the market. And we don't know when those best 10 days are, right? And that's the problem with getting out. A lot of the times, they say here in this graph that 7 of the best 10 days in the market occur within 2 weeks of the 10 worst days. So if you were one of those people that panicked during those 10 worst days, within 2 weeks, the 7 out of those 10 days actually occur within 2 weeks. So we don't have the crystal ball. Now, they also show if you miss 20 best days, if you did that, the average would have been 2.63%, and that 10,000 would have grown to only 16,804. If you miss the 30 best days, 10,904, only 0.43 return. If you miss the best 40 days, you would have lost 1.51%, that 10,000 would have gone down to 7,372. If you miss 50 best days, you would have lost 3.25% and would have gone down to 5,162 because this is on average, right? And if you miss the best 60 days, you would have lost an average of 4.85% and your money would have gone down to 3,698, which is amazing, right? So think about basically cutting your return in half just by missing the 10 best days in the market, which is why I'm saying you want to have a long-term strategy and you do not want to play the market. You want to be diversified and you do not want to panic sell, right? So if your goal is years out and you do not need this money right now, do not panic sell and stay in the market. Obviously speak with your financial advisor, make sure that you're in the proper portfolio, risk tolerance, take all that stuff into account. But as a general concept, you do not want to panic sell. Now, another thing I wanted to tell you is if you are in a situation where you're still currently investing money, say you already have your emergency savings set aside, you have extra money that you've set aside for the ability to take advantage of opportunities, then this could be a great opportunity also to get into the market and actually buy while it's low. Obviously, we don't know if it's going to continue to go down. We don't know when the lowest day is. But one strategy that you can use is called dollar cost averaging, where you invest a certain amount of money on a given day of the month. So let's say you say, you know what, every 15th day of the month, I'm just going to buy. Over time, you're going to get a better average price for those equities that you're buying as opposed to just buying in one lump sum, right? Now, another benefit could be what some people refer to as buying the dip, right? When the stock market takes the dip. Right now, the S&P 500, as of the recording of this podcast, year to date in 2022 is down just slightly above 14%, right? So a lot of people actually see that as an opportunity and say, you know what? Stock market is down 14%. Why don't I take advantage of this with this extra cash that I have and actually buy some stuff so that I can take advantage of the rebound and be able to then grow my investment portfolio even further, right? So there's another opportunity for you to kind of reframe the way you think about it and consider the fact that this, in fact, might be an opportunity if you are in a position to continue to add to your investments, or if you already are, whether it's via your 401k, your IRAs, or any brokerage account that you have, right? So think about it that way. It's kind of like a lot of people like to refer to it as the stock market going on sale. But obviously, nobody likes to see their money go down, the value of their investments go down. It's hard to stomach sometimes, and rightfully so, right? But if it's long-term money and you have enough time for business cycles and stock market cycles to happen, then it might be a great opportunity for you to actually buy the dip. So this is why I recommend working with an advisor, because a lot of the times, it's become very easy for people to invest. You could do it from your phone, right? Just download an app and start adding money to something. But what happens is that can be a double-edged sword. Yes, it's easier and it's great because more people get access to being able to invest. But at the same time, if you have no guidance and you don't have a third party that can work with you and help you know your risk tolerance, diversify your portfolio, and also help you from making a bad decision during market downturns because you might be fearful, which you have every right to be, that's where the human advisor comes in, right? And can help you with that. So investing is just one part of your overall financial plan. And this is why I highly recommend that you consider speaking to somebody that can help you overall to develop a strategy around all of your investments, the ones in your 401k, the ones for any other type of project you're working on in the future, and also just help you overall with all of your finances, right? Because that way one hand knows what the other one's doing. So just as a recap, you want to make sure that do not invest any money that you need for the short term. If you do invest, make sure it's for the long term, that you know what your risk tolerance is, that you have a diversified portfolio so that you don't have all your eggs in one basket. And also, you want to make sure that when the market is down, you do not panic, do not make any emotional, fear-based decisions. If you are in a position where you can continue to add, look at it as an opportunity to actually buy the dip and dollar cost average so that you get a better average price overall. And just remember that the S&P 500 has returned on average historically over 10%. Obviously, history doesn't necessarily indicate what's going to happen in the future, but just wanted to provide that as some context, because selling while it's low and then buying while it's high is a recipe for disaster. As you can see on that impact of being out of the market for the JP Morgan retirement guide, you can actually make it where you lose money as a result of fear-based selling. All right. So I hope you find this information useful. Tune in to the next episodes. I will continue to have some great content for you and some guests coming up in the future. And as always, if you have any questions, send an email, luis@onmywaytowealth.com. Thank you all for tuning in, and I'll see you on the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.